Okay, good morning, everyone. So today, we are going to finish the discussion on fiscal policy, and then we won't have class on Wednesday, and we should have a happy holiday on Wednesday, right? So let's see where we are in terms of fiscal policy, right? So fiscal policy is defined by these slides. Essentially, it's the use of taxes, government transfer, or government purchase of goods and service to shift the aggregate demand curve, right? So the main point of fiscal policy is trying to affect aggregate demand, right? So aggregate demand. And then the tool the government use is through taxes or government transfer, government purchase of goods and service. So this is called fiscal policy. So different administration as they may have different they have different preference over fiscal tools. Some may prefer tax cut, the other may prefer spending change, right? And in last class, we also talk about the first characterization of fiscal policy. This includes expansionary fiscal policy versus contractionary fiscal policy. So the expansionary fiscal policy is used to boost the economy activity, right? You can think of that as we add extra fuels for the economy. On the other hand, we have contractionary fiscal policy. So the contractionary fiscal policy is trying to slow down the economy. So you can think about you just press the brakes for the economy, right? So expansionary fiscal policy typically applied when we have a negative demand shock, right? So we are here. So basically, we have recessionary gap. So this recessionary gap is caused by a negative demand shock. And then, so this expansionary fiscal policy can boost the economic activity, okay, lift up aggregate demand, restore the long-run equilibrium. So this is expansionary fiscal policy. And then when we should have expansionary fiscal policy. On the other hand, contractionary fiscal policy is when the economy is overheat, right? So typically caused by a positive demand shock, and then so we have inflationary gap in the sense price is high, and so we produce more than we can potentially produce, right? So this contractionary fiscal policy help the economy to cool down, to avoid further inflation down the road, right? So those are the two types of fiscal policy. And then so we also talk about some critiques regarding to fiscal policy. So there are three critiques, right? So first, people may say government spending crowd out private spending. So the argument is based on the facts. So we may have limit amount of resource to use, right? But this idea may not be true. Just think about, so maybe the economy is producing below its potential, right? So think about the recessionary gap, okay? And then, so instead of crowd out private spending, so the government spending will lift up the aggregate production. So it may end up with boost up private spending, okay? The second critique says government borrowing always crowd out private investment spending. So this is similar to the first one, right? Just imagine if the economy is producing below potential, and then so the government borrowing so can make our pie, I mean, in terms of size of the economy, larger. So that is going to allow everybody to borrow more from the financial market because we have more savings. Okay? And lastly, so there's argument says government budget deficit reduce private spending. So this is not true. So the idea is similar, right? By the way, so here, this is related to recording equivalence, right? So whether you borrow to finance spending or use tax to finance spending to the households is equivalent. So that's the idea of recording equivalence. And then in the class, we explain, so this may not be true. Just think about if the government borrow to finance tax cut, to stimulate the economy, but then the government borrow in a very long maturity, think about 100 years of bond. And then so the government is going to pay off the debt in 100 years. Okay, so that is going to have real impact on the economy. Those are the three critiques and our answer to those critiques, right? All right, so the other things we talk about in last class is that fiscal policy suffers significant lags in its use. Or in other words, typically take times for fiscal policy to become effective, right? It's because it takes time to realize the actual state of the economy, whether we are in a recession or we are in an expansion, because it takes time to collect data. The secondly, once we realize where we are, but then so we need to take time to develop a plan. And finally, even though the plan passes in Congress, right? But this plan is going to take time to reach the actual economy, right? So overall, so it's going to take time for the fiscal policy actually affect our real economy, right? And let's see what else we have talked about last class. We also talk about this multiplier, right? So this is multiplier, essentially it's government spending money, so that's going to have a chain rule on the aggregate expenditure, right? But depending on how the government spends money, whether this money is spent by cutting tax or this money is spent by direct government purchase, so their net impact is going to be different. So we have to look at the example. Okay? So the main difference coming from the fact if the government decides to use the money to purchase goods and service, and then so immediately that's going to have an impact on aggregate expenditure. On the other hand, if the government decides to use the money to cut tax, and then so the initial spending is going to be smaller because households won't spend all the money they receive as a tax cut or transfer. So that's the main difference, right? And then so you can see over time or down the road, okay, through this chain rule, you can see the aggregate impact of government purchase of goods and service is much bigger compared to a tax cut or transfer. Okay, so this is a multiplier. Right. All right, so now we are going to look at other dimension that is going to differentiate between two types of fiscal policy. Okay, so one is called automatic stabilizer. The other is called discretionary fiscal policy. Okay, what is the difference? So automatic stabilizer is a fiscal policy set in motion. And then so whenever the economic situation changes, so you don't need to do anything from the government side. And then so the policy is going to affect the economy and adjust the economy automatically. So this is automatic stabilizer. On the other hand, discretionary fiscal policy is a policy must carry out depending on certain situation, or that's up to the government discretion, right? So whether I'm going to use that policy or not, so this is based on the judgment of the government, right? So the government is going to change their policy from time to time. So this is called discretion. Now let me give you an example, okay? So first look at what is automatic stabilizer, okay? So unemployment insurance is a perfect example of automatic stabilizer. So what is unemployment insurance? The unemployment insurance just says, okay, so if someone lost their job and claim unemployment, and then so they can go to Social Security office to claim this insurance benefit. Okay, so this insurance benefit so requires two things. Number one, you are unemployed. And then number two, so this insurance benefit is going to based on so your employment, so like your where you are, right? So this once this unemployment insurance scheme is set in motion, the government doesn't need to do anything. Okay, so they just leave the economy aside. Okay, but now let's see how that is going to affect the economy. So when we are in a recession, okay, so that means we are going to experience high unemployment, right? So that just means so there are more people qualified for unemployment insurance. And then so if there are more people qualified for unemployment insurance, and then so automatically the government is going to provide more help to the economy. But this help is going to boost up aggregate demand. Why is that? It's because this unemployment insurance is going to help those who lost their job to pay for their bill. And otherwise, those people is going to cut their spending, right? So in that sense, this unemployment insurance benefit is going to lift up aggregate demand automatically when we are in a recession. On the other hand, if the economy is in expansion, that means there are less people unemployed. Then there are less people qualified for unemployment insurance, and there are less people to claim unemployment insurance. Just keep in mind, so government hasn't done anything yet. It just set up rule and leave the economy moving, right? So in this expansion, there are less people qualified for unemployment insurance. So in that sense, that's going to help to reduce the aggregate demand, right? Because there are less people can receive this benefit from the government. So from here, you can see, so this unemployment insurance is going to automatically adjust aggregate demand, okay, depending on the economic situation, right? So the government hasn't done anything. Once after it set this policy rule, right? So this is automatic stabilizer. But what is discretionary fiscal policy? Right? So just think about at the beginning of this year, so the economy was hit by the pandemic. And then so the government decide this is an emergency, right? So this is a crisis. And then so we need to design a special policy to help the economy, right? So this is one time. So this is an emergency response, right? So this is discretionary, right? So these are two types of fiscal policy, right? Now here we can look at a practice question to understand what we have there. Holding everything else constant, the multiplier effect for taxes or transfer A is the same as the multiplier effect for changes in autonomous aggregate spending. So from the example we just talked about, this is not the case, right? B is smaller than the multiplier effect for changes in autonomous aggregate spending. So actually B is correct. Okay. So this change of autonomous aggregate spending, this is similar to changes in government spending, because these changes in autonomous aggregate spending is going to immediately has an impact on aggregate demand and plus the follow-up, right? But then so this multiplier effect of taxes, so it's going to work through in the initial state, it's going to work through changes in income for households. And then the household is going to spend a fraction of those changes in income coming from tax cut or transfer. So that's why it is smaller. Okay. So here we can look at the historical experience to understand the impact of multiplier, right? And also to understand the impact of government spending. Okay. So this is 2009 to 2013, so after the financial crisis. So pretty much most of the advanced economy, so they have carried out certain type of stimulus, right? But so they have different policies. Some may be expansionary, some may be contractionary, right? And so you can see, so if you spend less on the, all right, so here, so on the horizontal line, this is a cyclically adjusted budget balance. So if it's negative, which means you have a deficit, meaning so the government increase spending or decrease tax. On the other hand, so if you have a positive budget balance, meaning you are running a surplus, right? Meaning you cut government spending or increase tax. And then so clearly you can see there is a inverse relationship. The more you spend, let's go to this dimension, this direction, and then the higher percentage change in GDP, right? Or larger the multiplier, right? Okay, so the next things we will discuss in this chapter is to look at government's budget balance, so that we are going to look at the government debt. Okay, but first of all, so from earlier discussion, we have discussed, we understand a surplus and a deficit, right? So what is surplus? Essentially, the government tax revenue is greater than government spending. So meaning, so the government's income is larger than their spending, so they have surplus. On the other hand, so if taxes they collect, tax revenues collect is less than government spending, so meaning, so the government is running a deficit. But now, so how they're going to finance this deficit, or what they're going to do with the surplus? Okay, but so if we look at worldwide, if you look at history, so almost all countries runs deficit for most of the time. Very few countries, or even United States, in very few time periods, very few years, we run a surplus. Most of the time, so we run deficit. Now the question is, how we are going to finance this deficit? Okay, the answer to that is, so the government is going to borrow to finance the deficit, right? And in here, so we can look at the, so that's called a debt, right? So when we say the government borrow, so essentially government is running some debt. So they borrow to finance their spending, right? And over time, the deficit is going to lead to ever larger debt, right? So if you have, so currently if you have a deficit, so that's going to make your debt burden increase. Over time, the debt is going to accumulate. For the United States, so this is the total debt, how the total debt look like, right? So if you click the link here, okay, so you're going to see the debt is increasing, right? Is much larger than this, right? But if we look at the absolute value at here, it doesn't tell you too much. So a more meaningful way to look at debt is look at debt as GDP, right? So GDP is to think about, that's the economy's income, and the debt is what you own, right, as the economy, right? So this ratio, it just tells us more information compared with this absolute value. Because if this ratio is very large, meaning so we have larger fraction of income needs to pay off of our debt, right? So this ratio is more meaningful in the sense that gives us a measurability to what extent we are able to pay off our debt. Okay. And then so here, so we can look at a few equations to better understand the relationship between government budget balance and the fiscal policy. We start with this equation: saving from the government equal to T stands for tax revenue, G is government spending, purchase of goods and service, and the TR is transfer. Think about the government spending on Social Security, Medicare, Medicaid, food stamps. Okay. A budget surplus, as I explained in previous slide, is a positive budget balance, meaning T is greater than the summation of the last two terms. On the other hand, deficit, meaning so you have a negative budget balance, meaning T is less than the summation of G and the TR. Okay. So now we can link the deficit or surplus or the budget balance with the earlier things we discussed, including expansionary fiscal policy and a contractionary fiscal policy. Right? So an expansionary fiscal policy is going to make our budget balance worse. Why is that? Expansionary fiscal policy will reduce tax, increase government spending, increase transfer. So that's going to make the government budget worse, goes to more negative territory. On the other hand, a contractionary fiscal policy is going to make our budget balance looks better. Why? A contractionary fiscal policy will increase tax, decrease government spending, and decrease the transfer. So that's going to make the government's budget better, right? And then think about when the government want to have an expansionary fiscal policy and when the government may carry out contractionary fiscal policy. So typically, so the government has an expansionary fiscal policy when the economy is in recession. On the other hand, so they may carry out contractionary fiscal policy when we are in expansion. And to summarize, that just means so the government budget will become more negative during recession. And then, so when the economy is in expansion, so that's going to help us to repair our budget balance. Or so the government can pay off their debt, can reduce their deficit in good time. So this is similar to households, right? In households, so you may want to borrow to overcome some economic hardship during your downtime. Okay, and then so hopefully, so when you have higher income or if you have a better job, and then you may want to pay off your debt, right? So this is particularly true thing about individuals' life cycle, right? So when you are in the students, so in the college, so you borrow. So if you borrow through like student loan or you borrow through credit card, right? And then so once you get a job and then you start to pay off your debt, right? So this is a similar idea. Okay. So if we look at the budget deficit or the budget balance, okay, so this is United States from 1964 to 2013. So of course, so these things is going to fluctuate, right? And then so they just to confirm what we discussed in previous slides, when the economy in recession, so those are in recessions. So the budget deficit will spike, okay, it's increased. And when we are in the expansion, and particularly think about this long expansion, you can see there's a gradual decline or long decline in budget deficit, right? So that's just confirm the things we just discussed in previous slides. Okay, but then so here, and from this discussion, we also should realize the fluctuation in budget balance. Some of them are due to the effect of business cycle. When we in recession, this is going to go up. When we are in an expansion, this goes down. So this fluctuation is going to partially is coming from the fluctuation in our economy, right? So and then to understand the physical health of the economy, and we also look at the cyclically adjusted, right? So what is cyclically adjusted? Wait a second, maybe next slide. Right. So what is cyclically adjusted balanced budget? So first we look at two different. So this one, this purple one is actual budget deficit. And then so this brown or reddish one is cyclically adjusted, right? And what's the difference? The difference is when we are in recession, the cyclically adjusted budget deficit is smaller compared to actual. When we are in the when we are in the expansion, and then the cyclically adjusted deficit is slightly larger than the actual deficit. The difference the difference coming from the fact, so the actual budgeted deficit has our actual employment level, right? And then, so this is cyclically adjusted budget deficit. So we just plug in the potential employment level. And then, so what's the difference of these two employment? So when we are in a recession, the actual unemployment is less than the potential. So that just means the tax revenue we can collect in recession is going to smaller compared to our potential. So that just means the tax, the fiscal deficit will be larger in the actual economy compared if the economy is running our potential. So that explains the difference between this actual and the cyclically adjusted. And then why we want to do that is because this cyclically adjusted budget deficit give us better information regarding to the physical health. Think about in the long run. Right? So in the short run, so this actual budget deficit is much higher than cyclically adjusted. It's due to the facts temporarily, so we have high unemployment. And that leads to lower tax revenue, larger government spending or transfer. Right? But in the long run, so what we need to worry about is the cyclically adjusted budget deficit. So that is going to have impact on our long-term debt to GDP ratio or the long-term debt burden to the economy. Right? So one way to think about that is, so yes, temporarily when we in a recession, we have a spike in physical deficit. But then, so when we are in a good time, so you can see we also have a dip in budget deficit. Right? So these two over time is going to cancel each other. So that's why it's better to look at cyclically adjusted budget deficit. So one slide we miss is here. So budget deficit as a percentage of GDP move closely with unemployment rate. Right? So when we are in a recession like here, unemployment went up and then so the deficit increased. When we are in the expansion, unemployment decline and the deficit decline. Right? So that explains so why we look at cyclically adjusted budget deficit. Okay. And here just give you a real life example. So what is bond and how the government borrow through debt. Right. Okay, now let's look at another practice question. Holding everything else constant. The government's deficit A tends to increase during a recession. That is correct. B tends to increase during expansion. No, actually it's going to decrease. And C will increase if the government pursues expansionary fiscal policy. That's correct, right? So expansionary fiscal policy will decrease T, increase G, and the TR. So that's exactly what government will do during a recession. So hence answer is D. Both A and C are correct. Right. Okay. So now, so let me explain to you different thoughts about the government budget balance. Right. So as we have seen from previous slides, the government deficit will have impact on debt. Okay? You may think about, typical people may think about debt, it's not good, right? So debt is a burden, right? So debt is going to affect your future financial health as an individual, right? So and then, so similarly, so when we think about the government, and then there are people arguing, so we need to have a balanced budget. So which means we want to set the deficit equal to 0. So you spend based on how much you can earn, right? So here are the logic behind this balanced budget, right? So if we require annual balanced budget, but then so we lose the ability to help during recession. Okay? And the balanced budget over the business cycle on average, and trust the politicians keep the long run budget healthy. So okay, sorry. So this is essentially like a two different view, right? So above this line, so those are the thoughts. Think a balanced budget will hurt the economy in the sense if we requires a balanced budget, that is going to undermine the government's ability to help the economy. Think about it when we are in a recession, and then presumably we should have an expansionary fiscal policy. But now if the government is required to run a balanced budget, and then so the government's ability to carry out expansionary fiscal policy will be very limited. So this is one view. On the other hand, so there are people arguing against to give the government flexibility in setting the budget balance. Why is that? This is because so they don't believe the politician has the will, has the discipline to keep our long-run budget healthy. Or in other words, they was worried about the politician always has a temptation to borrow, okay, to run deficit. Because by borrowing, by run deficit, so they can improve the current economy. So that's going to help them to win election or to help them to become more popular, right? But that is going to lead to long-term damage to the economy because they must borrow, but eventually they are going to accumulate large debt. So, so this group of thoughts and advocate against a more relaxed budget balance. Right. In reaction, okay, so in 1999, some European nations, they adopted a common currency, which is called euro, right, as a requirement in order to join this euro. And then so each government, they must keep their budget deficit below 3% of their GDP. Okay, so why? So there's such a requirement. This is just used to keep the euro stable. Okay, so we may pick up that later when we discuss monetary policy. Okay, so this regulation or this pact or this agreement, it turns out largely limited a country's ability to use fiscal policy, particularly during downturn. Okay, so that is why after 2008 financial crisis, those European countries lost their confidence of their investor, right? Because they do not have much tools to use to fight the recession, right? And by the way, so we can go back to the earlier slide to see what happens in those countries after 2008 financial crisis. So that's kind of explains so what's different. This is the graph we have seen, right? So Portugal, Spain, it's Italy, Ireland, Netherlands, pretty much everyone, right? So they have very limited ability to use expansionary fiscal policy because they are required to keep their deficit within 3% of the total GDP. Right? So that explains so why they don't have that ability to stimulate the economy. And that also explains so why their GDP declined more significantly. Okay. Now let's back to here. Right, so here just compare Germany versus Greece. So Germany, so they have, start with Greece. So Greece, so they have a persistent budget deficit over long run. So that's caused their debt to accumulate, and eventually, so the investor was worried about they won't have the ability to pay off their debt, and then nobody wants to lend to them, and as a consequence, their interest rate spikes. That's going to make the borrowing even more difficult, right? Right, so now here, so I guess it's a time to explain to you the difference between deficit versus debt, right? So deficit and debt, so they are intertwined. They are closely related, right? Why? It's because deficit must finance by debt, and the debt is going to, so deficit must finance by debt. But if you have a larger debt, and then you're more likely to run a deficit because you have a large interest payment to make, right? So they are linked, but they are not the same thing, right? Okay, so here, so you can see, as I just explained to you earlier, pretty much any single country has a larger debt, except Norway. So they have, instead of debt, so they have saving. Okay, so let me see what else we have. Sorry. So now we are very much close to the end of this chapter, right? So where we are. Right. And then the other concern regarding to rising public debt is that public debt may crowd out investment spending, which is going to reduce long-run economic growth. Right. So in the extreme case, if the government accumulate large amount of debt, the debt is so large, so the government may want to default. And what is default? Essentially, the government failed to make a payment to the debt obligation they're supposed to make. Right? If that is the case, that's going to result in economic and financial turmoil, or it's going to result in a collapse in financial market. Right? So that is going to reduce long-run economic growth. So that is one of the main reasons why most of the economists worry about the ever increase in public debt. So hence, so we always look at debt to GDP ratio, right? And here, so we comparing, or we show two time series side by side. One is budget deficit. The other is debt to GDP ratio. You can see these two kind of track each other. So whenever the budget deficit increase, and then the public debt will climb up. Whenever the budget deficit declines, and then the debt is going to decline, right? Okay, so regarding to debt, there's one thing is important, but has been largely overlooked, right? So this is called implicit liability. So what is implicit liability for the government? So essentially, those are the spending promised by the government, okay? But they're effective at debt. The example includes Social Security payment or Medicare, right? So those are the things the government promised they are going to pay to the retired citizens, right? So with this regardless what happened to the economy. So they agreed. So when you retired, you're going to receive social security benefit, and then you're going to get free healthcare, right? But then, so how we are going to finance these things, right? So that is going to affect the government's budget balance. And then, so accordingly, that's going to lead to further debt on the shoulder of the government. And so this is called implicit liability. And this implicit liability can be enormous in the United States. Say, for example, right? Look at here. So we have from 2000 to 2038. And so to the right-hand side of this line is just projection. On the left-hand side is actual data. Okay? And here so we look at Medicare, Medicaid, and the CHIPS. So essentially those insurance for elderly, for low income, right? And then so we also look at Social Security. So both are considered as implicit liability. And due to aging population and rising healthcare costs, so these two things becomes an ever larger burden to the economy. Now, as you can see from here, it's the number has increased from 7% of the total GDP to 10%. It is projected to reach 15% of total GDP by 2038. So this is going to have implication on government's budget in terms of the deficit and in terms of long-term debt level. Right. Right, so I'm going to stop here for the new material, right? And today, so yeah, so I'm going to show you a video. So we said we want to watch last time. And then so once we're done with the video, and then so I can expand to you a little bit on this an exam and bonus point.